Big picture, top-down analysis, because a lot of times you don't really want to go there.
I actually have an opinion on this one.
Good.
Are U.S. markets under a bubble? Investor Steve Eisman cautions that if the Fed proceeds with rate reduction this year, a stock market bubble may be in the works, but meanwhile, he's also optimistic about a few stocks and their performance. You must be familiar with Steve, famous for his housing market wagers in the Big Short television series. Eisman has stated that the central bank should hold off on raising interest rates this year, citing a robust economy. Why does Eisman have such an opinion? Big Short investor Steve Eisman predicts that if the Federal Reserve proceeds with rate reduction this year, a stock market bubble will develop. I think the economy is doing well. He recently declared, "In my opinion, there shouldn't be any Fed cuts this year" on CNBC Squawk Box. He also added that my main concern is that the market would get really agitated and we would have a serious issue if the Fed were to truly lower rates. You know, things are going well. The Fed needs to remain silent and wait for the statistics to deteriorate. Wall Street Veterans' 2024 S&P 500 price estimates have increased due to the strong profit growth in large tech stocks, notwithstanding the persistence of the equity market bubble idea. However, in the wake of the most recent inflation signaling PCE and ISM manufacturing statistics, the expectation of rate cuts, a stimulant for market performance, has lost most of its momentum. Eisman has regularly pointed out that the unemployment rate is declining, salaries are increasing, and the only thing to be concerned about is that some items are becoming more expensive due to inflation. He sees all the statistics advising against jumping into a rate cut by the Fed. Doesn't that sound strange when Eisman has such views on the Fed and the after effects due to the decisions by the Fed? There's still a shortage of jobs, so the consumer is fine, he stated. It's a little bear's porridge in a way, so why would you spoil it by lowering rates? The leading investor added that as history has already demonstrated, that there's nothing worse than the Fed initially lowering rates before raising them again when needed. I constantly consider the years 1999 and 2000 when there was unquestionably a bubble in the market. However, the fact that the Fed hiked interest rates significantly and caused the economy to enter a recession killed the bubble, not the fact that it was a bubble, he continued. Eisman came to the following conclusion. Given how simple it is to take action, it could be the most difficult thing for a portfolio manager to do nothing. The Fed operates in the same manner. They could cut anything they wanted to since it's so simple to do so. Nevertheless, Fed Chairman Jerome Powell maintained the rate at the FOMC meeting in March while restating the Fed's intention to cut 3 interest rates this year. Eisman disagrees with Powell's dovish approach. Eisman believes that the market will decline this year despite his criticism of the Fed and the US government. He had also spoken of placing large bets on specific sectors. Which are they and what gives him hope for them? According to Big Short investor Steve Eisman, the impressive stock market surge of 2023 will continue as long as the US economy is robust. It's becoming somewhat frantic. However, it might continue for a little longer because Eisman stated in a Bloomberg interview, "I don't see why people are going to sell their stocks as long as the economic data is okay." Eisman was probably referring to recent economic statistics that indicate the United States is doing better economically than most people realize. The labor market has remained strong with low unemployment, inflation is quickly declining, and consistent equity gains have contributed to the S&P 500 entering a bull market. Exuberance among investors about the deployment of artificial intelligence has contributed significantly to this year's market surge as they've piled into well-known tech stocks such as Apple, Microsoft, and Nvidia. In an effort to control inflation, the Federal Reserve has increased interest rates by 500 basis points since March 2022, yet the stock market has remained upbeat throughout this entire time. Eisman stated that in light of the upheaval that the financial industry experienced earlier this year, he is currently concentrating his investments in technology and infrastructure and staying away from bank stocks. The regional banks pose a challenge as they consistently lose their deposits and must continually lower their balance sheets. He referred to U.S. regional banks when he remarked, "So for the regionals, I don't think earnings have bottomed and I wouldn't even think about buying them until I thought that they had." If you notice, the price of credit card debt, vehicle loans, and mortgages have increased. Higher rates could negatively affect the economy as a whole and the government's finances. Is the U.S. Treasury planning to borrow money in the near future? The fourth quarter of 2023 saw a minor decrease in the U.S. government's borrowing needs compared to the previous quarter, which might be a significant event during a volatile period for the global bond market. The U.S. Department of the Treasury made a widely followed announcement that it would be seeking to borrow $776 billion. This amount is less than the $1.01 trillion in privately held marketable debt that the department borrowed during the July through September period, which was a record high for that specific quarter. Wall Street strategists at JP Morgan Chase stated that they had anticipated the announcement to be approximately $800 billion, so the borrowing amount looked to be a little lower than that. Following the Treasury's announcement in July of increased borrowing requirements, the bond market went into meltdown, with rates reaching their highest point since 2007, the start of the world financial crisis. Despite giving up some of their gains, stocks continued to rise following the announcement. Most Treasury yields increased. Because of the government's need for borrowing and the Federal Reserve's restrictive policies, markets have been concerned about the impact of higher yields. Authorities ascribed the reduced requirement for borrowing to increased revenues, which were slightly counterbalanced by increased overlays. Although inflation has slowed, it's still significantly above the Federal Reserve's objective, according to an accompanying economic assessment, which also showed that growth has remained robust. In recent times, the Federal Reserve has posed the biggest risk to the soft landing of the economy. Bond yields are rising due to higher for longer interest rates, which are causing the economy to falter. So what exactly is the threat to the U.S. Federal Reserve? The increase in longer-term rates comes at the same time as other risks, such as rising gas costs, the start of student loan installments, and the ongoing strike by automakers, and the possibility of a government shutdown next month, all of which could reduce consumer spending and stimulate the economy. In the upcoming months, car sales may decline as a result of the United Auto Workers strike, which is currently in its third week with no end in sight. Furthermore, there's always a chance of a government shutdown, which was just avoided this past weekend due to the disarray surrounding the House of Representatives' leadership. After a successful summer driven by high consumer spending on travel, music tours, and blockbuster movies, the economy is winding down. Goldman Sachs researchers believe that the economy expanded at a robust 3.5% annual rate during the July to September quarter last year. However, the significant increase in borrowing costs may make the economy slow down more severely. The yield on the 10-year Treasury increased from 3.3% in April 2023 to a 16-year high of 4.8% in April 2024. Seeing all these happenings, we all wish we had some magical, infallible guidance to break this pattern. Regrettably, it appears that the existing economic structure in America, and to be honest, other nations, is intentionally intended to keep people in rough conditions. How do we normal people combat these conditions? For a normal person, it's not as easy as pulling yourself up by your bootstraps to get out of financial difficulties. Recalling that this is a marathon, not a sprint, is the best advice. Don't try to solve all of these issues at once. You won't be able to. Rather, attempt to gradually chip away at them. Maybe you'll set aside a little more money for a slightly better pair of boots the next time you need them. Alternatively, you begin setting away a modest sum of money each month to help you pay for your subsequent little fix. Try not to spend an unexpected windfall, such as an inheritance or an unexpected bonus from work, impulsively. Determine whether there's a method to use wisely that will end up saving you money in the future. If you can, you should use the money you save in the future to make even greater savings. It's difficult to claw your way out of poverty. It requires a great deal of effort, selflessness, and a little bit of luck. Do you think Steve Eisman's warning should be taken seriously by the US government and the Federal Reserve? Do share your thoughts on this in the comments section below. For more interesting stories and updates, subscribe to our channel and don't forget to press the bell icon for notifications. Bye for now.